All right, so this is Matt Brua from Fairway Independent Mortgage. I'm Jay Reid with Home Smart Connect. I asked Matt to come on today to have a conversation with me regarding the mortgage industry and how it's going to impact here the upcoming 2026 spring market. Maybe some misconceptions that are roaming around out there. I want to clarify and get it straight from the expert and share it with everybody out there. Okay. So Matt, if you want to let people know a little bit about yourself, that'd be great.
Yeah, you got it. Thanks, Jay. So I've been doing mortgage for, I don't know why we call it that. We call it mortgage for 27 years, actually, Jay. It's the only career I've ever had. 27 years, actually, out of Mundelein, Libertyville here in northern Illinois, but we have a license in Indiana, Illinois, and Wisconsin, and been doing it quite a long time, but I believe it's kind of one of the best ways to build your net worth. So that's why I stay doing this. And my financial contribution to this world is to help people build their net worth. So that's kind of my philosophy. And two ways of building net worth, I think, is stock market and real estate. And I so happen to be in the real estate side of it.
Excellent. Very good. So I've known Matt and his family for a long time. Your mom and dad started the Century 21 there in Mundelein off of 176. I know your brother really well. I haven't talked to him in a while, but yeah, Matt and his family, good people. Our kids went to school together, or your nephew and Nathan played basketball together on the team over there at Carmel, So yeah, I've known Matt a long time and I trust Matt, and he's helped a lot of our clients. He's helped a lot of agents in the area. They know Matt. He's very well known. So this advice today, I think you could take stock in it. And so why don't we start, Matt? So we talked a little earlier about some of the things that most people are probably going to be wanting to ask you about. I think the first thing on my mind is, what do you see the interest rates doing this upcoming year? I know that the Federal Reserve is making some cuts, but a lot of times people confuse that directly with the mortgages, and it's not. And sometimes it's already baked into the market, right? So why don't you tell me what you're seeing as far as interest rate trends coming into 2026?
Yeah. So our market, which is the mortgage-backed securities market, Jay, is typically 3 months to 9 months ahead of what they believe the Federal Reserve is going to do with short-term interest rates. But what the Fed is doing is they're lowering short-term interest rates. So your bank loans, your car loans, your credit cards, your home equity line of credits, that's what they're doing when they lower short-term interest rates. Long-term interest rates try to be 3 months, 9 months ahead of what the Fed is going to do. So if you want to know what the Federal Reserve is going to do, you watch two major indicators. One is inflation, and they love inflation to be close to 2%. Some people say it's not a realistic number anymore. It's like 3.3% year over year right now. The other is unemployment. So unemployment keeps notching up just a little bit every time they check it every month. So those are the two big indicators that the Federal Reserve is worried about. Is one, how are people's jobs going? And two, what is the price of the average good? And people, you think of eggs, Jay, right? So,
Yep.
I'm blessed enough to not know eggs. I don't do a lot of shopping, but eggs evidently were 99 cents 5 years ago. Now they're not 99 cents. Well, that's direct inflation. So, and that's what the Federal Reserve is mostly concerned about. So what do I believe interest rates are going to do? And now, again, just my opinion, if you see unemployment continue to kick up or move up a little bit, and you see inflation stay in that 2 to 3 to 4% range, that gives the Federal Reserve green light to continue to lower interest rates to stimulate the economy to make sure unemployment doesn't go up. So if they're going to lower interest rates futuristically, our interest rates should follow suit. And we saw that this summer, Jay. If you bought a house in early July, you would have paid 7.25%, 7.5%. Whereas right now you're probably paying closer to 6.5%, because they believe the Fed's going to continue to cut rates another quarter, maybe another half here in the coming months.
Got it. And the $1 million question everybody's asking you, and they're going to say, we're not going to hold you to it, but they are.
Yeah, they do.
What are the rates going to do here further on in the next, let's say, first quarter, going into the first quarter? And this is when the market really takes off. The spring market, I was just looking at a chart today, and yeah, this is like the holidays and it cools off, but man, it comes right back in January. And I always tell the sellers, get ready to sell. Put your home on the market in January. Yeah. Hit that first group of really proactive A+ buyers. That is the best group of buyers coming out of the gate to buy homes, in my opinion. So those folks, that thinking, okay, I want to do something first quarter. Are they going to be missing out on lower rates if they do something the first quarter versus waiting to the second quarter? So this is where I need a little guidance from you to
Yeah.
let them know.
Yeah.
Again, it's
Yeah.
a
The
million
crystal
dollar
ball.
question, right? Yeah. Yeah.
Yeah. So, I mean, obviously, if you look at average interest rates over the last 50 years, Jay, actually, believe it or not, the average interest rate of the last 50 years is like 7.7%. People can't believe that to be true. But back before I got into mortgage, interest rates were at 17, 18%. So that was in the early 80s. That was when hyperinflation was going. We go back to that word inflation. But what do I think the rates are going to do? Well, there's good news and bad news, right? So, well, good news and good news. If you buy, and let's say you lock in an interest rate of 6.25%, like right now we have a convention. If you buy with us, we'll buy your interest rate down 0.5% for 1 year for free. So Fairway, my corporate team, will do that. So we give you a free half-inch reduction, or half a point interest rate reduction the first year. But let's say you buy today and you get 6.25 on a 30-year fix, and next June they're at 5.5, and you have $500,000 on that loan. There's nothing that stops you from refinancing. You can refinance anytime you want on a mortgage, Jay. So if rates are at 6.25 1 month, and then 6 months later they're at 5.5 or 5%, you can refinance that loan at any time. So
what do they say, like about a half a point makes sense, or at what point does it make sense to refinance?
yeah, so kind of my general rule with my clients is when you can make back the closing costs within 6 months to 10 months of refinancing, it's time to refinance. So that is loan amount dependent. Because if you're financing $1 million, that might be a half percent reduction. If you finance 100,000, you might need a 2% reduction.
That makes sense. That makes
Yeah.
sense. Okay. All right. Well, that's really good news. So here's the other part that a lot of people have a problem with is like the equity's tied up in their home
Yeah.
and they want to buy, but it's really hard to buy a home with a home sale contingency and even a home close contingency for that matter. And so we have to get a little creative to help our clients understand that there's options out there to allow them to go in the eyes of who they're buying from as non-contingent, right?
Yeah.
So tell me what products you have that could aid these folks in that situation.
Yeah. So if you want to be really proactive and you think you're going to list next spring, I would go out and get a line of credit on my house right now. So I'd call my bank, whoever you bank with, or there's multiple, like there's a great credit union one out of Vernon Hills. I send all my clients to, Jay. You go get a line of credit and you get that line of credit for the maximum that they'll give you. So if they'll give you 90% of the value of your home, you go get your line of credit at 90%. What that's going to do is when you go to buy your new house, you're going to already have what is called a bridge loan set up. It's going to allow you to have access to the equity of your current house and use that to buy your new house. So if you were to go buy a new house and you can afford it, maybe, meaning if you can carry 2 mortgage payments at the exact same time based on your income, a lot of people can, Jay, believe it or not. A lot of people don't know this, but they can carry 2 mortgages at the exact same time. So you would use your home equity line of credit as your bridge loan. Now, if you don't want to be proactive, like I'll just handle it when it comes down the road, which a lot of us do, right? Mm-hmm. You can get a true bridge loan. And a bridge loan, what that does is gives you access to the equity of your property, and it alleviates not having to make a mortgage payment on that old house. So that's a bridge loan. And then the third option, I do a lot of actually this year, I probably did 30 or 40 of these, Jay, where what happens is they just put up 5% on their new house. And they would go back and sell their old house. And then what happens is they'd bring their equity over from their old house, maybe 100,000, maybe 200,000. They would bring that to their new house and they would do what is called a recast. Now, what the recast allows you to do, Jay, this is a really cool feature in mortgage, is that it allows you to spend $200 or $300, bring over 200 grand of the sale of your old house to your new mortgage, and then it resets that payment based on your new principal balance.
In other words, no refinance necessary. It's
no refinance necessary. That's right.
Just resetting the mortgage.
That's right. You're just resetting the payment based on the new principal balance when you sell that old house. So it really becomes it becomes really easy and inexpensive to do it that way. Now, here's the other thing, Jay, to think about is if I was a buyer, typically the winter months are a great time to buy because price per square foot comes down a little bit, right? Mm-hmm. So if I was a buyer and I locked in a price, say January 15th, and I closed the end of January, my first new mortgage payment wouldn't be due until March 1st. So I would have basically till March 1st to get rid of my old house before I had 2 mortgage payments due anyways. Because remember, you're always behind, a month behind in your principal interest payment. So it gives you 45 days to get rid of the old house, or 3 weeks, and you know better than anybody in this market, you can get rid of houses pretty quickly if you really want to.
Yeah, the month supply of inventory in our area is about a month, month and a half supply. And here's the other misconception: people watch the national news and
Yeah.
they're lumping Chicago into the equation of what everybody, not everybody, but certain parts of the country are going through, right?
Yes,
Chicago is held up very well. Do you have something to show us?
I do actually. I've got that. I want to show you this if you don't mind.
Not a problem.
While I find it again, let me just. Oh, there it is. Hang on. Sorry.
Take your time. That's no big deal. We can wait for
Yeah,
you.
actually, this is really fun to look at. So, if you think back on where we were pre-pandemic, so you and I both been in this business a long time. Most people are, they only come in once in a while, and show my screen anyway. So you should see a map of the U.S., correct?
I see it. Yep.
Okay.
Active housing inventory. Yep.
Yeah. So if you think about this, Jay, this is the housing inventory across the United States pre-pandemic levels. So this is July of 2019 to July of 2025. And what I want to highlight here is that in Illinois, we're negative 63% of inventory. So what that means is this: if there was 1 million houses for sale in July of 2019, there would be basically 360,000 houses for sale today versus July. That's why. And if you look at the Midwest, look at how much the Midwest is catching up with the rest of the country, because all these other states, Texas, Florida, California, Nevada, they all doubled in price within the last 5 years, right?
Yep.
And we're still on the climb, and we have such a great housing, or such a great employment track around here. We have so many corporate offices. We have so much building and corporate coming in here. There's nothing to say that we're not going to continue to do this. And if you look at year over year, we're at 6 or 7% appreciation right now, last 3-4 years. Whereas I think you said the other day, Florida was negative 11% this year over year. So we're just catching up.
Yep. Exactly. Yeah. So Illinois is held up very well. Chicagoland is held up very well.
Yes.
Again, this is a really, really great map. If you could email that to me as well, that'd be great.
Yeah, I will. Yeah, I'll put that, and I'll see if I can put it in the chat. I don't know if we start chat, but I will make sure you have it so you can give it to clients as well. But that's, when you look at year over year appreciation, is now a good time to buy. And, I was always taught, like Jay, you said, my family's been in real estate a long time. I was always taught, if you're going to live somewhere more than a year or two, probably 2 years, you're going to be okay in most markets, because you're going to get a 3 to 6% rate of appreciation. If you live there 2 years, you get a 10% appreciation. You've more than covered your cost of living there. You're more than covered your cost of selling it, all the acquisition costs that go along with buying for real estate. That the appreciation is what makes this game fun. So
yeah, absolutely. All right. Is there anything you want to share that we haven't talked about yet? I know there's a few other things we kind of touched on earlier today when we're talking, but I don't think that's really something we need to get into right now. I think we kind of hit the main key points, right? Is there anything else that you could, talk about that you think would be about?
Yeah. You know what, Jay, I think the only thing, like, for your clients and clients you talk to, is just how proactive can they be, right? If you think you want to sell in the spring and you're going to want to buy non-contingent, which as a buyer, you should think non-contingent, because if not, your offer probably won't get accepted. So be proactive. Go get your line of credit set up. Explore the bridge loan. Get it pre-approved as quickly as you possibly can, because that'll get you ready to go when that time comes. You actually want to pull the trigger on getting your place sold, and you want to actually look at houses, because they are still going very right. Even right now, Jay, we talked about this, is that I have all my buyers are still in multiple offer situations. It is definitely not the national average of buyers are getting 5-10% off. That is not the case here in Chicagoland by any means right now.
Exactly. One last thing then, how do they get pre-approved through you? What's the process?
Yeah, I would love for them to call us. We're old school. So if we pick up the phone, if you call my office, we'll pick it up. It's 847-487-9915. My last name is Brua, Brua. You can Google me, and I'm very easy to find because we have a very unique name. It makes finding me way easier in life on Google as well. But my office is out of Libertyville. My team's out of Libertyville. And yeah, we'd love to help people out.
All right, let's do this again early in the spring, kind of a follow-up.
Okay.
All right.
That sounds great.
You, man. Yeah.
Yeah. Thanks, Jay. Take care, buddy.
All right.
Good luck, everybody. Yep. Bye-bye.
Bye.